Chakri Lokapriya from TCG Asset Management joins us right now on the show. Chakri, good afternoon. Thanks so much for joining in.
Good morning.
Great you spending some time with us today. What's the sense, Chakri? A very sharp pullback from those 10,000 levels all the way to 10,900. Now some bit of jitters on the global front is starting to correct. Can this correction deepen?
You know, India also has elections coming up, rather election results coming up in the next couple of days, tomorrow. And so against this backdrop, there is bound to be a volatility downwards. So I think this is a time to stay on the sidelines, and because there is still some more confusion for it to settle down. But if you are a medium to long-term investor, I would actually start looking to buy at current levels.
Okay. Does this staying on the sidelines is the apt advice, Chakri? But just wondering, you know, we actually put it out yesterday as well. OPEC today, the election verdict tomorrow, or the exit polls tomorrow, then the election verdict, then the Fed meet as well. Does this period come with a larger bias towards the downside? Even if you stay on the sidelines, do you reckon that accumulation could happen at lower levels as well, or do you believe that the market is primed up right now for staying at the current levels because of the growth factors, etc., etc.?
You know, it's a tale of two halves. If you look at the world, the US is still doing economically really good. Unemployment at phenomenally at 40-year lows, consumer inflation very low. So it's highly unlikely that, so where some of the market participants talk about a recession coming in the US, which is highly unlikely. So against this backdrop, the concern is more whether domestic growth can pick up. So which means from an Indian perspective, the IT companies, the pharma, the export sectors, they will continue to do well, because, and you should use the opportunity if there's any weakness in these sectors to buy. On the other hand, the pure domestic names, there's still some more downside, and especially the infra and the utilities.
Okay, just from you know, the looks of it now, once it's probably going to be the next quarter numbers is going to gain more importance now that quarter two is out of the way. But any pockets now that look, you know, actually attractive from the point of view that you could see a turnaround? Because for one, auto as a pocket, if you were to see this quarter, wasn't all that great. I mean, volume numbers were a little bit more subdued. Do you see the cycle turning here?
If you look at you know, both the short-term cycles of the last couple of years and slightly longer, over the 4-5 year cycles, the volumes are down for auto companies over the shorter term. So which means that, you know, even if you look at longer term averages, today the consumer has slowed down for various reasons. And this can be a combination of higher insurance factors, higher interest rates, and uncertainty, and therefore waiting it out. So against this backdrop, seasonally, it's unlikely that the volumes will pick up for autos anytime soon. And if you look at their valuations and ROEs, they are trading at their historical 5-year, 7-year averages. So there is no real, what you call, support for the stock at the current levels from a valuation perspective. So I think volumes are unlikely to recover in the second half, and therefore the stocks at best will trade range with a downward bias.
What did you make of you know, the RBI policy yesterday, and obviously what they mentioned with regards to benchmarking retail loans to global benchmarks, and how does that play out?
You know, two things. From RBI's last month to this month, oil is down 30% last time when they came to this time around, and they could have taken that into account and probably changed their stance to a neutral stance rather than maintaining the calibrated approach. Which, what do you calibrate with oil down 30%? Which means inflation is, in RBI's own admission, is going to be 3% odd going forward in the second half. So which actually indicates that there is inflation is not a risk, therefore interest rates should not be a risk. And now this MC benchmarking thing, now you'll have different banks benchmarking to different benchmarks, and therefore from an analyst perspective, you would have to take that into account, whether one is taking a GSEC rate or somebody is taking a repo rate as their benchmark and putting a spread on top of that. So it is then they adds a bit of apples and oranges comparisons, which seems to be the order of the day in terms of the new norms coming out. So it's just going to make analyst life a little bit more difficult going forward. But outside of that, I don't think any meaningful difference.
Interesting. Chakri, we have a lot of election data, and I'm sure we're going to be talking to you on the election verdict day as well. So maybe I'll save some of that for that day. And I want to stick to some key movers and shakers which could be impacted because of the global moves. The metal space, the Vedantas, JSW Steels, Tata Steels, ferrous, non-ferrous, etc. Everything is getting beaten down. Is this essentially this worries of the global GDP growth coming off and therefore commodity prices likely to cool off? Because the correction has been fairly steep.
Yeah, it's a combination of two things. If you look at Indian metal companies, all the names that you mentioned, JSW Steel, Tata Steel, Hindalco. Hindalco probably less so, but the other two companies have a far higher level of debt. So if you go fast forward into the future and commodities being a cyclical thing and they turn down, will their cost of servicing go up is the concern. And they're trading at probably in line with historical averages, so they're not exactly very cheap. So from that perspective, but I would still hold on because at 9-10 times PE, they're not expensive stocks at all. So it largely depends on whether the commodity cycle stays intact, which we think it will, at least for the next couple of years.
Okay.
We were having a look at some of the bigger IT names as well, and while some of them are trading at their peak valuations, I'm not getting into stocks, but just as an example, HCL Tech for that matter is relatively cheaply valued versus some of its peer with the same kind of growth potential, maybe slightly lower. So would you start to differentiate and start picking out those value buys where growth potentials are sanguine, but valuations compared to peers with not a very big difference in growth is way lower?
HCL Technologies and even Hexaware is a good example of how these companies, their ROEs have actually trended up in the last few years. And but the re-rating in the stocks has not happened. Now, HCL Tech, out of the large TCS, Wipro, TCS, ICI, Infosys, and the other big guys, is always treated as a poor cousin and given a lower multiple.
Always, yeah.
And so I think, and market has kind of ignored the improvement in its fundamental metrics. So against this backdrop, it is an inexpensive stock trading at about 11, 12 times, and earnings potential will maintain good 15% going into the next out. So I think it is a stock to buy, and so is a Hexaware or in the mid-cap space, a company like Cyient, which has corrected quite a lot last month but not recovered since.
Okay. Just wondering, Chakri, you scan a bunch of spaces in order to manage your portfolio management services. You guys, I think, recently got awarded as one of the best emerging PMSs as well, so congratulations on that. But
thank you.
When you look at that entire sphere, where is it that you feel that there is the best bang for the buck if somebody is willing to hold on for the next 3 years? It's not necessarily a 6-month argument. Elections will come, elections will go, other factors all will go down, all will go up. But if you 3 years view, what's the best space to invest money in right now?
I still think it is the banks. And
what kind of banks?
Both the PSU banks as well as retail banks. And especially if you take an SBI today, it's trading at 0.9 times book. Union Bank is trading at half a time book. Canara Bank, example, trading at 0.4 times book. So are you telling me that 60% of its loans will be written off? Highly unlikely. So all these, some of it will be written back, in fact, if you give it a sufficiently long period of time. So if you, and that's on one hand, and second is, just when you say this retail versus corporate, if you take ICICI, Axis, even SBI for that matter, all these guys are increasing their percentage of their total loan book in lending to retail, car loans, that kind of stuff. So which means that line is going to blur between a pure corporate bank who has a greater bias, which is largely the PSU banks. But within the private banks with corporate and retail, that line will blur in a couple of years out. They'll have both retail as well as corporate lending as their overall book. So against that, all their valuations will kind of coincide, converge. So against that backdrop, I think a number of banks will move up the curve. So they'll still make far more returns than the index if you hold it.
All right. The other part, while you're speaking about banks, is do you see the challenges for NBFCs persisting?
NBFCs, yeah, the liquidity needs to be provided at least for the next several months, which I guess RBI is acknowledging will do so. But the loan growth rates will come down quite dramatically from the 30% plus to probably to the mid-teens thing. So yes, valuations will come down, but I think it's still a space to look at because there are lots of good companies out there and valuations have corrected.
A white bucket, what do you look at?
I'll look at those companies which have a less of an asset liability mismatch. You look at an M&M Financial Services or a Magma FinCorp, which is corrected like 60-70%, trading at one-time book. Sundaram Finance, a well-run company. So these are the kind of companies that I look at.
No, probably just from perspective, maybe housing finance or individual loan profiles, depending on that.
Housing finance companies still, they still LIC still looks good at a 1.5 times book, but if you look at what there is going to be some amount of asset liability mismatch. The housing companies today have the greatest asset liability mismatch, which will correct itself in the coming quarters. So from that perspective, I'll stay away for now, but bit later maybe.
Very interesting. I was just scanning the list of underperformers, and utilities form a large bucket, Chakri, out there. Anything from a Tata Power, despite the moves upwards on a valuation basis compared to the 10-year averages, is trading at a substantial discount. Do you think that discount gets filled? A Tata Power, a Coal India, PFC, REC for that matter, even though they are in news for different reasons?
Yeah. I think it's highly unlikely that the valuation is going to be
no.
It depends largely on whether the regulators allow a pass-through of costs and a pass-through in their final selling price. Today, all these companies are facing losses. So now, I think that will be the biggest overhang, which is highly difficult to predict. So I think, and if those two things happen, if they're able to pass their costs plus make a profit on top of it, that's the reason why any company exists, should exist rather.
Should exist, yeah.
And so that, but I think that's still far away.
Yeah. Okay, Chakri, we'll leave it at that. Thanks so much for taking the time out and being with us today and giving us your perspectives. Really appreciate your time.